Hello friends, welcome back to another video. Now from this video, we are starting the mock test of second paper of JAIIB, that is Principles and Practices of Banking. And this video comprises of the first module, that is General Banking Awareness. As usual in this video also, we will focus primarily on exam-oriented conceptual questions. But before we start, don't forget to get your JAIIB Masters Pack from the link given in description of this video. Now, this is a pack of 4 Power Pack books. All these are 1000 series question banks of IEIFS paper, Principles paper, Accounting paper and Retail Banking and Wealth Management paper. Now all these books contains super special 1000 plus questions which are very important for your examination. All the books contains real exam level questions and that too with updated difficulty level. Now these are chapter wise question banks, so it's easier for you to finish this in a step by step manner. Not only this, the question bank comes with lots of case studies and numericals and that too with detailed solutions. The best part of this is that you get my full support with respect to any problem or issue you may face in these question banks. All the links are there in description of this video, so don't miss out to get these amazing books. Next friends, let's start with today's mock test. And the first question is from chapter 1, that is Banker-Customer Relationship. And the question goes like this. Consider a scenario where a corporate entity approaches a bank to manage the proceeds from a large real estate transaction. The entity wishes to ensure that the funds are used strictly for paying construction costs to specific contractors. Which banking product would best suit the entity's requirements and what are the key features of this product that align with the entity's needs? And these options are given to you. That is, first option is a current account and the key features are allowing unrestricted access to funds for any purpose. Then second option B is a term deposit and the feature is securing the funds and earning interest until needed. Then third option C is an escrow account and the feature is where funds are disbursed only when predefined conditions are met. And last option D is a non-resident external account and the feature is offering repatriation of funds to foreign contractors. Now friends, please note the correct option for the given question is option C. Please note an escrow account is a financial arrangement where a third party, often a bank, holds and regulates payment of funds required for the two parties involved in a transaction. This account provides security to both the payer and payee by ensuring that the funds are disbursed only when preconditions such as satisfactory completion of a project milestone or receipt of some documents are met. Now as you can see, this aligns perfectly with our question's entity's needs to ensure that proceeds from the real estate transaction are used exclusively for paying construction costs to specific contractors. So I hope the explanation is clear to you. The next question is from chapter 4, that is opening accounts of various types of customers. And the question is, a limited liability partnership, that is LLP, with a turnover of Rs 35 lakhs is planning its financial strategy for next fiscal year. What are the compliance requirements concerning the LLP's financial structure and operations under the defined category of a small LLP? And these options are given to you. That is, first option is the LLP must file annual financial statements only if its turnover exceeds Rs 40 lakhs. The next statement is the LLP qualifies as a small LLP and is exempt from mandatory DPIN registration from designated partners. Then third option C is the LLP's turnover threshold categorization does not impact the needs for DPINs, which are optional. And last option D is the LLP qualifies as a small LLP and its designated partners must obtain DPIN to comply with LLP agreement and maintain financial transparency. Now friends, please note a small limited liability partnership, that is small LLP, is defined under Indian regulations as a LLP with a contribution that does not exceed Rs 25 lakhs and a turnover that does not exceed Rs 40 lakhs as per statement of account and solvency for immediately preceding financial year. And since the LLP in our question has a turnover of Rs 35 lakhs, so it qualifies as a small LLP. Then next, let's look at the compliance requirements for small LLPs. First is the requirement of designated partner identification number, that is DPIN. Friends, regardless of being a small LLP, designated partners must obtain a designated partner identification number, that is DPIN. The DPIN is mandatory for designated partners to legally operate and represent the LLP. Friends, this ensures that the partnership meets its regulatory requirements and maintains proper accountability and transparency in its operations. The next is annual compliance. Friends, despite qualifying as a small LLP, the entity must also comply with filing annual financial statements and returns. The category of small LLP may offer certain relaxations in compliance burdens, such as reduced filing fees or simplified reporting formats, but it doesn't exempt the LLP from essential compliance obligations like obtaining DPINs for its designated partners. The next is impact of turnover threshold. Friends, the turnover threshold of Rs 40 lakhs is crucial as it differentiates small LLPs from larger LLPs. Falling under the small LLP category simplifies some of the compliance process, but it doesn't alter the fundamental requirements such as the need of DPINs. All designated partners must hold a DPIN which acts as an identification number. So friends, as far as this question goes, the correct option is option D. Then next question is from chapter 5, that is operational aspects of deposit accounts, and the question goes like this. Which of the following categories of accounts are not required to be transferred to inoperative account status even if they are dormant? And the answer choices are these. That is, first option is accounts under lien or charge for advances allowed to the same customer in another account. Then second option B is savings account with balances below the minimum required balance. Then third option C is current accounts with no transactions for over 1 year. And last option D is fixed deposit accounts maturing in less than 3 months. Now friends, please note accounts under lien or charge for advances allowed to the same customer in another account are exempted from being transferred to inoperative account status, and even if they have a dormant status. Now this is because these accounts are actively held as collateral against loans and advances, and therefore remain functionally tied to financial arrangements of the customer. So as far as this question goes, the correct option is option A. Next friends, there are some other exceptions as well. And these include, first, the accounts where operations have been stopped under a garnishee order or any court order. Friends, these accounts are legally restricted from transactions until the court order is resolved. Then second is accounts that by nature permit only periodic operations, such as some types of escrow or trust account that are designed for specific non-regular transactions. And lastly, the accounts that are under court-mandated restrictions or some legal holds for debt recovery actions, which may also include scenarios where accounts are pledged against loans or have other legal encumbrances preventing regular operation. So friends, I hope the explanation is clear to you. Now, before moving ahead, don't forget to subscribe this channel since this is the only channel that provides quality content. Also join my Facebook group where I post lots of one-pagers, mock questions and other useful stuff which is very important for your examination. You can also join my Telegram channel and connect with me on my LinkedIn profile as well. All the links to join are there in description of this video, so do join after you finish this video. The next question is from chapter 6, that is operational aspects of handling clearing or collection or cash. And the question goes like this. A bank implementing the positive pay system for high-value checks above Rs 5 lakhs observes that some customers are not compliant with the system requirements, leading to delays in check processing. As a financial analyst, you need to assess the impact of this non-compliance on bank's liquidity and risk management. Which of the following best describes the potential consequences? And these options are given to you. That is, first option is the bank's liquidity requirements will increase due to delayed clearing, leading to higher cost of short-term borrowing. The next statement B is non-compliance will have no significant impact on liquidity as the system only involves additional verification steps. Then third option C is the bank will face increased fraud risk but will not experience liquidity changes. And last option D is there will be no impact on the bank's financial operations as check processing is automated. Friends, please note the positive pay system is a fraud detection tool that requires the reconfirmation of key check details for large value transactions such as the check number, date, payee name and amount before the check is processed for payment. So this system is designated to prevent the check fraud by allowing the bank to cross-check the details provided by customer with the actual check presented for clearing. Next friends, when customers fail to comply with this requirement of positive pay system, such as not submitting the necessary check details or providing incorrect information, it can result in bank delaying the check processing. Now, this delay can disrupt the normal clearing cycle, which in turn affects the bank's liquidity management. Now friends, this is because banks rely on predictable cash flows from check clearing to maintain their liquidity positions. Delays caused by non-compliance can result in bank needing additional liquidity to meet its short-term obligations. And this potentially leads to an increased reliance on short-term borrowing options such as interbank loans or overdrafts. Now, in short, we can say that non-compliance with positive pay system does not merely affect fraud prevention but also has broader financial implications for the bank, particularly in terms of increased liquidity requirements and associated costs, and thereby affecting the overall efficiency of banks' cash management operations. Thus, the correct option for the given question is option A. The next question is from chapter 7, that is banker-special relationship. And the question goes like this. A bank holds various securities from a customer who has multiple types of debts with the bank, including an unsecured loan and a credit line for which the securities were specifically pledged. If the customer defaults on the unsecured loan, under what conditions can the bank exercise its right of lien on pledged securities? And these options are given to you. That is, first option is the bank can exercise the lien on pledged securities for any debt, including the unsecured loan, as there are no restrictions. Then second option B is the bank cannot exercise its lien on the pledged securities unless they were pledged explicitly for unsecured loan. Then third option C is the bank may exercise its lien on any securities as long as the total debt owed is greater than the value of the pledged securities. And last option D is the bank can only exercise its lien on the pledged securities if there is a general agreement allowing cross-collateralization. Now friends, please note the right of lien does not extend to the securities pledged for a specific purpose, which in our question is for securing a credit line for debts unrelated to the purpose, which in our question is unsecured loan. Therefore, unless the securities were pledged specifically for unsecured loan or there is a general agreement allowing for such lien, the bank cannot exercise this right on the pledged securities. Thus, the correct option for the given question is option B. Next friends, if you are enjoying the content and found it useful till now, then don't miss to like this video, since this tells me that you are loving the content and it also motivates me to make more such awesome content. I would love to connect with you all on the LinkedIn as well. You can connect me from the link given in description of this video. Next, let's move forward with our mock test. Then next question is from chapter 8, that is foreign exchange remittance facilities for individuals. And the question goes like this. A financial consultant advises a non-resident Indian, that is NRI, to invest in capital instruments of a listed Indian company under Foreign Portfolio Investment Scheme, that is FPI scheme. To comply with FEMA regulations, what is the maximum allowable investment threshold for NRI to maintain their investment under FPI category? And what are the implications if this threshold is crossed? And these options are given to you. That is, first option is up to 10% of total paid up equity capital, and the implication is crossing the threshold categorizes the investment as foreign direct investment. Then second option B is up to 5% of paid up equity capital, and the implication is crossing the threshold results in the investment restriction by the RBI. Then third option C is up to 15% of the equity capital, and the implication is exceeding this limit requires additional approval from SEBI. And last option D is there is no specific limit, and the implication is the NRI can invest freely as long as funds are routed through authorized channels. Now friends, please note foreign portfolio investment, that is FPI, is defined as an investment by a person resident outside India where the investment is less than 10% of the post-issue paid up equity capital of a listed Indian company. And if this threshold is crossed, the investment is reclassified as foreign direct investment, subjecting it to different regulatory requirements under FEMA. So as far as this question goes, the correct option is option A. The next question is from chapter 10, that is foreign currency accounts for residents and other aspects. And the question goes like this. Which of the following is not a feature of exchange earners foreign currency, that is EEFC account offered to Indian exporters? And these options are given to you. That is, first option is EEFC account holders can retain 100% of their export earnings for foreign currency. Then second option B is EEFC account does not earn any interest on foreign currency balance. Then third option C is the balance in an EEFC account can only be used for any permissible current or capital account transactions without conversion to INR. And last option D is EEFC account balances are freely repatriable without any restrictions. Now friends, please note an exchange earners foreign currency, that is EEFC account, is a special account offered to Indian residents, particularly exporters, that allow them to retain foreign exchange earnings without converting them to Indian rupees, that is INR. But friends, there are specific rules and features associated with EEFC accounts that you must all know. First is EEFC account can retain 100% of their export earnings in foreign exchange currency. Now, this is nothing but our option A. Friends, initially there were certain limits on the amount of export earnings that could be retained in foreign currency. However, under current regulations, exporters can retain up to 100% of their export earnings in an EEFC account, and this allows them to avoid the exchange rate risk associated with immediate conversion to INR. Then second is EEFC account does not earn any interest on the foreign currency balance. Now, this is nothing but our option B. Friends, unlike other types of accounts, EEFC accounts are non-interest bearing. Now, this policy encourages account holders to convert the funds into INR at any good time or use them for permissible expenses rather than simply holding larger sums of foreign currency for long periods. The next, EEFC account balances are freely repatriable without restrictions. And this is nothing but our option D. Friends, funds held in EEFC account are fully repatriable. Now, this means that the account holder can transfer the funds abroad or use them for other foreign currency related transactions without any restrictions. This allows account holders for the use of funds for making payments for imports, business travels and other permissible expenses in foreign currency without needing to convert the funds into INR first. Then lastly, as you can see, option C states that the balance in an EEFC account can be used for any permissible current and capital account transactions without converting to INR. Now friends, this statement is incorrect because EEFC account can only be used for current account transactions such as payment for imports, foreign travel and other similar expenditures. EEFC account funds cannot be used for capital account transactions, which include investments in foreign entities, acquisition of foreign assets, or any transactions that affect the capital stock of the economy. Lastly, capital account transactions are subject to stricter regulatory oversight and separate permissions from the Reserve Bank of India is required for such activities. So it is important to note that EEFC account balances are restricted to current account transactions only. So as you can see, as far as this question is concerned, the correct option is option C. That is, option C is incorrect. That is, statement of option C is incorrect. The next question is from chapter 12, that is payment and collection of checks and other negotiable instruments. And the question goes like this. A check has been endorsed with the condition pay Shrimati Manorma or order, notice of dishonor waived. This indicates that the check has which type of endorsement, and these options are given to you. That is, first option is conditional endorsement, then second option B is restrictive endorsement, then third option C is facultative endorsement, and last option D is endorsement in full. Now friends, the correct option for the given question is option C. Please note, a facultative endorsement allows the endorser to modify or waive certain legal rights related to the negotiable instruments. Now in our case of the endorsement, pay Shrimati Manorma or order, notice of dishonor waived, the key point is that the endorser has chosen to waive the right to receive a formal notice if the check is dishonored. Friends, normally if a check is dishonored, the holder of the check must notify the endorser about this failure of payment, allowing the endorser to take action if necessary. However, by including the phrase notice of dishonor waived in the endorsement, the endorser is explicitly stating that they do not need to be informed if the check is dishonored. Now friends, this waiver simplifies the process, but the endorser still remains liable to the endorsee for the amount of the check. Friends, I hope the explanation is clear to you. The next question is from chapter 18, that is duties and rights of a banker and customer rights. And the question goes like this. A bank receives a garnishee order from a court for a customer's account with a credit balance of rupees 5 lakhs. The garnishee order is for rupees 3 lakhs and the customer has issued a check of rupees 2 lakhs to third party that has not yet been cleared. What action should the bank take considering the garnishee order and unprocessed check? Assume the bank systems do not process transactions instantaneously. And these options are given to you. That is, first option is, the bank should process the check first and then honor the garnishee order if sufficient balance remains. Then second option B is, the bank must immediately block 3 lakhs, transfer it to sundry deposit account and allow the check to clear if remaining balance is sufficient. Then third option C is, the bank should block full rupees 5 lakhs balance in the account and await further instruction from the court. And last option D is, the bank can choose to honor the check since it was issued before the garnishee order was received. Now friends, please note, when the garnishee order is issued, the bank is legally required to freeze the specified amount in the customer's account. Now in our case, the bank must immediately block rupees 3 lakhs as directed by the court and transfer it to sundry deposit accounts, and also ensuring that no withdrawals affect the blocked amount. Now since the garnishee order is only for rupees 3 lakhs and the account balance is rupees 5 lakh, the bank can clear the customer's pending rupees 2 lakh check using this remaining funds. The bank is not allowed to freeze more than the specified amount, allowing operations to continue on the remaining balance while fulfilling its legal obligations. Friends, the important point to note here is that the order applies only to the balance at time of the issuance. So future deposits are not automatically subject to the freeze. Thus the correct option for the given question is option B. So friends, finally we have reached the last question of our mock test, and the question is from chapter 19, that is grievance redressal and RBI integrated ombudsman scheme. And the question goes like this. Which of the following is not a valid reason for the complainant to appeal against an ombudsman's award or rejection order? And the options given to you are these, that is, first option is, the complaint is not pursued with reasonable diligence. Then second option B is, the complaint requires elaborate documentary evidence. The next option C is, the complainant disagrees with the commercial decision of the regulated entity. And last option D is, the complaint is without sufficient cause. Now friends, please note, disagreement with the regulated entity's commercial decision is not a valid reason for a complainant to appeal against an ombudsman award or rejection order. However, the valid ground for a complainant to appeal against an award or rejection includes, first, lack of reasonable diligence. Friends, if the ombudsman concludes that the complainant did not pursue the complaint with reasonable effort or diligence, then this can be the reason for rejection. However, if the complainant feels they did not pursue the case diligently, then they can appeal against the rejection on this basis. The next is complaint without sufficient cause. Friends, if the ombudsman believes that the complaint does not have enough valid reasons or sufficient cause to proceed, then the complainant can appeal against this decision. Now friends, the complaint would be based on the claim that there was indeed a sufficient cause to justify the complaint. Last but not the least, need for elaborate documentary or oral evidence. Friends, some complaints require a deep analysis of documents or oral testimonies that might not be appropriate in the ombudsman proceedings. And if the ombudsman rejects a complaint on these grounds, the complainant may appeal by arguing that their case genuinely demands such consideration. On the other hand, a disagreement with a commercial judgment or decision made by the regulated entity is not valid grounds for an appeal. Commercial decisions, example interest rates set by the bank, lending policies, etc. are based on business discretion, and the ombudsman does not intervene in these unless there is evidence of a violation of rights or laws. Therefore, friends, appealing an ombudsman decision simply because the complainant disagrees with the business or financial decision of the entity is not accountable under the scheme. So, as far as this question goes, the correct option is option C. So friends, with this I wind up this video. I hope you found the content beneficial. Also, don't miss to get your JAIIB Masters Pack from the links given in description of this video. Combo pack comes with a discount as well, and you can even get individual books and also online versions as well. So thank you, and I will meet you again in another video.